What's up, YouTube? Today I wanted to do a breakdown of some businesses or stocks that I find really overpriced. And I want to do so because we're in a market right now where the Shiller PE is at 30. And it's been at 30 for quite a while. I mean, like 3 or 4 years. But it does sort of feel like we're in a bubble. And it feels like a lot of stocks are being too highly speculated. And so I want to present you guys with 3 stocks that I found that I find to be laughable, ridiculous, like off the charts. So our first stock, the first business that we're going to talk about is McDonald's. And funny enough, McDonald's, the stock price, it appears to even be more unhealthy than the food. At a $200 billion market cap, McDonald's really only generates about $7 billion worth of net income a year. And it's a business that has gone down in terms of revenue and market share since 2010. And so, they've actually increased margins in the last 10 years. And especially recently, it seems like McDonald's has raised their prices an awful lot, but they're not generating a whole lot more income on the amount of revenue that they're doing. And so when I look at McDonald's, when I look at the fact that they're selling at 30 times earnings, and it very well appears that their earnings are normalized. There aren't any strange goodwill write-offs or anything like that in the last 4 years. It seems to be a pretty normal cycle for their business in terms of how much they're making. I don't really understand where they're going to go. You can't buy securities that are at 30 times earnings that don't grow at all, like McDonald's, and expect to do well. You're not going to do well. And the worst part about McDonald's is it appears that their plan is to take all the money that they continue to make, and if they don't pay out all of it in dividends, they just buy back shares at 30 times earnings, which is, if they're not going to grow at all, that's like a 3 or 4% return on equity. It's honestly awful. And I flash back to when McDonald's, back in the early 2000s, it traded at a PE that was much lower. Much, much lower. In fact, there was a time, I believe, when McDonald's sold for about 5 times earnings. And then in about 2010, 2011, they were selling for about 10 times earnings. And it was about a 60 or 70 billion dollar market cap, while making $5 or $6 billion of net income. But now, in the present day, McDonald's sells for $200 billion. Yet they don't have prospects to make more money than they made back in 2010. It really doesn't make any sense at all. And if you want to lose money, if you want to get an awful return, invest in McDonald's. I honestly can't seem to find businesses that are more poorly priced than McDonald's. And I'd love to hear what sort of investor thinks this is a good deal at any level. I don't even think it'd be a good or even an okay deal at half the price. It's really shocking. Okay, guys, and so my next stock is IBM. And over the last decade, IBM has about halved their revenue. Net income was about 3 times what it is now back in 2010 for IBM. But for some reason, the market cap has not really gone down at all. They only generate about $6 billion of net income. Revenues and incomes or net income is going down. Their market share is objectively decreasing. It has so steadily for like a decade. But yet for some reason, a stock making $6 billion with poor prospects is selling for $135 billion. Does that make any sense at all? And as well, in investing, one of the most important questions is, what do you have? There is what you're making and what you have. What do you have in terms of assets cleared of liabilities? And when you look at that, IBM only has $20 billion. And so honestly, I'd say fair value for a stock like that is like 1/3 of what it's currently priced at. It really doesn't make a whole lot of sense. And these sort of stocks, IBM and McDonald's, these things scream bubble. They scream ridiculous. It's almost absurd. And when your average stocks are like this, you're not going to get good returns. And again, IBM is another stock that buys their shares back at prices that are well above what it's worth, which is awful. That's the worst thing that you can do with your cash. They'd be better off trying to invest it themselves at current prices. But they don't seem to make that decision. Okay guys, and my last stock is Hilton. Hilton, as a valuation, is kind of similar to McDonald's, where I don't really see a whole lot of growth, and I don't really see them doing a whole lot more in the future than they've done in the past. But yet they sell at 35 times earnings. And so Hilton is this sort of stock or security that did really poorly during COVID, and understandably. And they've been growing out of the recovery. And so when you look at their stock, you might see that revenues increased by 50% this year, but that's just returning back to what they should be. And Hilton, at best, is only going to generate $1.3, $1.5 billion worth of income, net income. And so to buy into a stock like that at a $40 billion market cap is just ridiculous. And Hilton is one of these securities that carry negative shareholder equity. And for a lot of stocks that might not matter a whole lot, that you carry negative shareholder equity, and I'm not saying it matters a lot for Hilton, but at the same time, a stock that has $1 billion to owe versus $9 billion to have is worth a lot more. And I don't like stocks that sell at negative shareholder equity, especially stocks that are so overvalued. And Hilton is yet another stock. All three of these stocks are securities or businesses that buy back their shares at ridiculous prices. It doesn't make sense. And when they buy back their shares at 30 times or normalized earnings, you're not going to do well. And so I warn all investors out there that there are lots of securities that sell at prices like this. It might not be as ridiculous, but even stocks like this at 1/2 of the price are things that you shouldn't buy. And your job is to find and to buy the most underpriced securities that you can find. You really don't need more than the 5 most underpriced independent businesses in the world to be a good investor. You don't have to mess around with all this noise. That's what Charlie Munger calls it. Don't mess around with the noise. And when you watch people like Buffett invests, he, in his early days, he would never spend time buying things that sold at anywhere near these valuations. He looked for stocks that were in obscure markets with a lot of book value compared to what they, sell for. with prospects that he didn't have to carry out too far into the future. He didn't care, he didn't care a whole lot about projecting out what something's going to do. He cared about analytics. What people have right now is a lot more easy to understand than trying to project out that McDonald's deserves to sell at 30 times earnings after revenues have declined for the last 10 years. And so, I just wanted to give a warning to anybody that watches this video to watch out, because I don't see very good returns on average securities in the next decade. Thanks for watching.